stock market. And then our market briefs afterwards will give us their financial news reports. And finally, I'm going to give some financial lectures today on how to evaluate a portfolio and as well as some classic portfolio examples so you can see their examples and learn kind of how to make a portfolio. So let's get started. So the return of the Hoperation Fund portfolio in June was negative 2.34%. So the total year to date is now around 19.6%. In June, I liquidated positions in Amazon, AVGO, TSM, ASML, FICO, and SOXX. And I slightly reduced positions in Google and Nvidia. In return, I purchased shares of XLK, which now represents about half of the total account capital. So the compound annualized growth rate, or in other words, the average return each year for the past 3 years, is 33.4%. And the total investment return of the Hoperation Fund portfolio is since its beginning is 143.2%. As of June 30th, the investment portfolio is now valued at $33,368. And here I'm decided to show you guys the capital of the Hoperation Fund each year since its beginning. Okay, next let's move on to our market analysis. Based on the long-term investment model of the Hoperation Fund, currently the midterm market direction is predicted to be bullish, while the long-term market direction is neutral. The CNN Fear and Greed Index is 32, so right in the fear category. The market valuation is still overvalued. The S&P 500 PE is 32.15, and the 10-year Treasury yield has slightly risen to 4.485%. I would suggest having most of your portfolio in stocks with a little bit in cash and cash equivalents. And now let's talk about the market top warning signal that I think I introduced last meeting. So last meeting, I talked to you guys about this signal, which is derived from many different financial data sources that can predict a market crash. So previously, last meeting, we saw that the signal was almost nearing the red line, which is the kind of the decision boundary. And then here is the new update of the signal since May 2026. And you can see that it has slightly slowed down a little. I don't know if you guys can see my mouse, but it hasn't crossed over the red line since. So the current state of the stock market, according to the signal, is still pretty ambiguous. It's uncertain whether the signal is going to cross over the boundary or just drop back down again. So I guess we have to just keep on watching and waiting, and I will give you guys more updates next meeting. Okay, now let's go on to our financial news for today. So I'm really excited to have our market briefs. Arav, Vihan, and Sebastian present their financial news. Does anyone want to present first? Like, anyone have a preference? Hmm.
I can go first.
Yeah, okay, cool. Arav, you can go first then. And I'll let
Okay.
you. Great.
My presentation is on how the World Cup is affecting the US stock market. The 2026 FIFA World Cup is the largest World Cup in history. It has 48 teams, 104 matches, with 16 host cities in the United States, Canada, and Mexico. This will affect the market because of sector-specific gains. Travel and hospitality, because hotels like Marriott and Hyatt, airlines, and online travel platforms could benefit from record attendance and booking volumes. Sportswear, because Nike and Adidas are projected to see 3 to 4% sales growth from jersey, footwear, and merchandise demand. Beverages, because they're expected to gain from stadium exclusive beer sales and higher on-premise consumption. The media and advertising, because broadcasters like Fox Corp, Comcast, and streaming platforms could see ad revenue spikes tied to U.S. coverage. Restaurants and foods, because trains with city host cities exposure may see increased foot traffic. In secondary ticketing and rideshare, platforms benefiting from resold tickets and event-related travel. The economic impact is that FIFA estimates that the United States could generate $17.2 billion from the event. The historical context from how much was gained was the host country revenue impact has been mixed. Qatar gained 10% in 2022, Russia gained 5.4% in 2018, and Brazil lost 19.5% in 2014. Some certain stocks and ETFs that you should invest in with the FIFA World Cup. US Global Jets ETF. This ETF will capture flight demand spike for fans traveling between host cities. Marriott, Hyber, Uber, and Lyft are all key consumer and hospitality stocks. Gabelli Opportunities in Live and Sports ETF, GOLS, includes Manchester United with several players in the 2026 tournament with other sports-related holdings. Fox, Google, and Meta are all media and entertainment stocks. Stocks that you should avoid and or be cautious around are the iShares MCCI Mexico ETF or EWW and the iShares MCCI Canada ETF EWC because World Cup because any host country boost is often already priced in and their performance depends on much more than the overall economy than the event itself.
Okay, thanks so much, Rob. I think a lot of us have been paying like attention to the World Cup. For some reason this year, I've been watching a lot of soccer, but I think many of us might not be wondering about the short-term effects of the World Cup. So thank you for that presentation. Vihan, Sebastian, anyone want to go next? Okay, Sebastian, cool.
Meta saw its stock price drop by about 5% after CEO Mark Zuckerberg admitted that the company's artificial intelligence projects are moving much slower than expected. In an internal meeting with employees, Zuckerberg confessed that the company's massive restructuring and recent job cuts haven't delivered the quick AI breakthroughs they had hoped for. On top of that, Meta had to officially pause a controversial internal program that tracked employee mouse movements to train its AI, following major concerns over data privacy. At the same time, the government released its latest employment report showing that U.S. employers added 57,000 new jobs last month. While the economy is still growing, this number was much lower than the 100,000 jobs that financial experts predicted. This slowdown signals that companies are becoming much more cautious about hiring new workers, which could make finding a new job a bit more competitive in the coming months.
Okay, thank you, Sebastian. Yeah, I was pretty interested about the meta thing. I feel like maybe it's just me, but I feel like it was kind of expected because I heard that they have been like firing and then like hiring a lot of employees really quickly. So I personally, for me, I felt like they didn't have enough time to do any AI breakthroughs. But thank you also, Sebastian, for that update on the US overall like market and economy. And yeah. Okay, Vihan, do you want to present yours next?
Sure. So I'm going to share which companies to invest in with with AI and stuff. So AI infrastructure costs a lot. The projected 2026 capex is cost is $725 billion for the big four AI companies, which are Amazon, Google, Meta, and OpenAI. Sorry, Microsoft, if I'm right. And 725 billion is a lot higher than the profit they're making from their AIs. So it's a lot of the tech companies that support AI, those AIs they only make money from like subscriptions. And some people just don't really want to buy subscriptions because they're happy enough with the free tiers that they're getting right now. And even if they're buying them, it's taking a lot of time for them to gain back money because most subscriptions are like $20 a month, and the annual ones are about 100. And major corporate enterprise clients are freezing software and IT upgrade budgets because boards want immediate proof, and the money they're getting isn't immediate. It's more of a really long-term project. So despite a lot of funding from Microsoft, Nvidia, Amazon, ChatGPT's market dominance is slipping, and its global web traffic share fell sharply from the historic 76% high as special open source models like Gemini and Claude fragmented the sector. And daily active user counts on core mobile AI applications have become a structural contradiction, since massive defensive funding rounds are functioning as corporate cash buffers rather than fueling viral user growth loops. So, um, this is kind of an extra thing. So, um, I noticed when I watched the Formula One races, it seems like teams like Williams and Claude have been sorry. Seems like Williams and McLaren have been getting AI sponsors like Claude and Gemini, and these are kinds of signs of desperation since Formula One sponsorships cost about $70 million a year. And if they got organic retention from advertisements and such, they wouldn't need to burn this much money a year on F1 paddock branding to find customers that way. And fund managers are actively rotating away from tech giants because of this, with bloated AI spending profiles and speculative futures, and their capital is rerouting directly into steady cash flowing value equities with clear metrics and clear plans instead of kinds of a gamble. In small cap benchmarks like the Russell 2000 are catching tailwinds since since they don't have any expensive AI infrastructure debt and they're getting clean profits from real world demands outside of AI. So what this means for us, Hoperation, is we should avoid the hole diggers like the big tech companies like Microsoft, Google, etc., since they have their infrastructure models cost too much, and we should invest in the shovel sellers, which are the chip companies that are selling, well, the chips, since they're actually making a lot more profit and their stocks are going up. Thank you.
Yeah, very interesting presentation, Vihan. I think AI has been like a pretty popular topic for investors like really recently. So yeah. Thank you for that presentation, and thank you to all of our market briefs for preparing such interesting and fascinating financial news reports for us. Oh, hold on. Wait, where are my slides? Wait. Cool. So after those financial news reports, let's move on. I have some announcements I want to make. So the first one is that I'm excited to announce a new fundraising initiative that our VPs have thought of, and that is a summer boot camp. So the boot camp will take place online from July 21st to July 24th for 4 days. It will be
Oh,
from
wait, Olivia, the
yeah.
time changed from July 20th to July 23rd.
Okay, cool.
Yeah.
From July 20th to July 23rd now? Okay. That cool. So the time will be 10 o'clock a.m. to 12:15 p.m. Mm, our three of our VPs, Isabella, Hank, and Oliver, will be organizing the boot camp and like giving the lectures. And this boot camp is mainly targeted towards younger kids, like fifth to eighth graders. Although I guess technically anyone can attend, but it will be teaching basic financial literacy and investing knowledge, such as assets, stocks, bonds, and there will be a real-time practice with a portfolio simulation, I think. So the fee will be $30 per person for the entire um, camp, so for all 4 days. And then I put a web page on the Hoperation Fund. So if you want to know more details, you can go to the fundraising 2026 page in the Hoperation Fund website, and then look at this flyer and you can scan a QR code for more information. So yeah, that's a quick announcement. Mm, I will ask our VP Isabella. She was the one who initiated the idea of the boot camp. Isabella, do you have anything else to add?
Yeah, so even if like you're not interested in attending, I think it would be really helpful if you were to send like the a screenshot of this flyer to any friends you know or any family, like spread the word. And also, this is just like basic knowledge. So if you want to return to the basics or freshen up your knowledge, this is a great chance to do that. And I think that's pretty much it. It'll be a lot of fun, and I would be really happy if you joined our camp.
Yep. Yeah. So thanks for that addition, Isabella. Yeah, if you know anyone else who might be interested, please share that to them. Mm. Okay, cool. By the way, I may or may not send an email later with this flyer, but you can also like find it on the website too. So yeah. Okay, next announcement. So I'm super excited to also um, establish a philanthropy committee. So you may be wondering, what is this philanthropy committee? So it is a committee where the members will individually research potential nonprofit recipients, evaluate their mission, impact, credibility, and alignment with Hoperation Fund's values, and recommend donation amounts. At each monthly meeting, the committee members will report on their research findings, including the nonprofits they explored, their missions, impact, and other key information. All Hoperation Fund members are welcome to participate. There isn't really an interview and you don't need any specific skill sets other than research abilities. But what you can build are capital allocation skills, which is the ability Warren Buffett views as one of the most important qualities of a successful CEO. So there is no time commitment for this position. If you want to join, then please email me. And um, if you want to like leave at any time, you can just email me again. And like it's just like if you have a specific charity idea or you want to try, then you can just email me, and then it's pretty flexible. So yeah, that's a really interesting opportunity, I think, for Hoperation Fund members who are interested in philanthropy and charitable giving. So please email me if you're interested. Okay, now let's move on to our financial lectures. Today I'm going to be talking about how to evaluate a portfolio as well as some classic portfolios. So you guys may have a question. Given so many investment portfolios or ETFs, such as the permanent portfolio, the all-season portfolios, the 60/40 portfolio, which are all portfolios that we're going to be talking about today, which one is the best? So the first step to evaluating a portfolio is always to obtain their monthly returns over at least 5 years. More than 10 years would be better, but if you don't have all that data, that's still fine. The reason for getting all this data is because you want to evaluate a portfolio over different time periods, scenarios, and economic or market conditions. A portfolio that performs better than another portfolio over one bull market might perform much, much worse than that second portfolio in a bear market. So you don't always know, which is why it's good to gather a lot of data. Step two is to calculate the following metrics. There are a lot of metrics, but the following are the most important ones: compound annualized growth return, standard deviation, maximum drawdown, and Sharpe ratio. So let's talk about compound annualized growth rate. And this is actually the metric I talked about earlier when I said the Hoperation Fund had 33.4% CAGR. So mathematically, the formula to calculate CAGR is this thing. It looks pretty complicated, but it actually isn't that complicated. It's just the ending value divided by the beginning value to the power of 1 over the number of years minus 1. So this thing, the ending value minus the beginning value, is basically the total return from the beginning to the end. And then just take it to the power of the reciprocal of the number of years, and then subtract the 1. So here is an interesting example for you guys. Given a portfolio, in year 1, its return is 20%. In year 2, its return is negative 15%. And in year 3, its return is 10%. So what's the CAGR over the 3 years? I'll give you guys 2 or 3 minutes to calculate this. Okay, I see Oliver's given me a response already. He says 3.91%. Okay, interesting. Let's see what everybody else's answers are. Okay, Hank says he got 3.9% as well, and so as Talon, I think, and Arav. Okay, cool, yeah. So let's go through this step by step. Oh, and Sebastian, I think, answered correctly too. Cool. So it's good that you guys all got this correct. But let's just review this. So basically, the ending value divided by the beginning value is just the total return from the beginning, from since the beginning. So this is 1 plus 20% times 1 minus 15% times 1 plus 10%, and that's 1.122. And using this above formula, plug in 3 for a number of years, we can calculate that the CAGR is approximately 3.91%. This means that on average, the portfolio grew by about 3.91% each year over the 3-year period. Oh, and by the way, if anyone is wondering, you can't just divide 1.122 by 3 because the returns are compounded. So like a 4% return in year 1 and a 5% return in year 2 doesn't mean the total return is 4 plus 5 equals 9%. So cool. That's compound annualized growth rate then. A next very common metric is standard deviation. This measures the dispersion of returns around the mean and is often used as a measure of risk or volatility. A higher standard deviation implies greater the dispersion of data points around the mean, and a smaller standard deviation, the better a portfolio is because the more stable the portfolio. And so this is the formula for standard deviation. It's denoted by the symbol called a sigma, I think. So it's it's basically it looks kind of complicated, but it's really not that. So here n is the number of observations, xi is each individual return. This is mu is the mean or average of the returns. This whole thing represents the squared deviation of each return from the mean. And then you sum over all of the individual returns and average them, and then take the square root. The square root is applied to the average of these squared deviations to return the results back to the original units of data. So here this is a visualization of two signals to show you guys what standard deviation means and kind of like what a high standard deviation, low standard deviation looks like. The blue line is ordinary signal, and the red line has 3 times the standard deviation of the blue line. So you can see it has a lot like bigger ups and downs. The next metric is drawdown or maximum drawdown. A drawdown refers to the decline in the value of a single investment or an investment portfolio from a relative peak value to a relative trough. A maximum drawdown is the maximum observed loss from a peak to the next trough of a portfolio. Mhm. So it's basically take all these mini drawdowns and find the largest. Drawdown values can be calculated based on monthly returns or daily returns, but we'll just use the monthly returns in the following examples. And of course, the smaller the max drawdown, the better portfolio is, because that means like the less of a loss it has at one time. And drawdown is calculated by taking the difference between the highest point and the lowest point and divided by the value at the highest point. So then the drawdown of this, say the highest point is at 100 and the trough is at 80, then you subtract 80 from 100 to get the difference between um, like the difference you get, and then divide by 100 because you want to find the percentage difference or percentage loss from the original highest point. So that's 100 minus 80 divided by 100, and that's equal to 20%. By the way, any questions so far? Okay, cool. Let's move on then. So next is the Sharpe ratio, and this is a very common, very popular metric. Sharpe ratio is the measure of risk-adjusted performance of the portfolio. It is calculated by dividing the mean monthly excess return of the portfolio over the risk-free rate by the standard deviation of the excess returns. And then the displayed value is annualized. So this is the formula for the Sharpe ratio. This is RP, which is the return of the portfolio, like the actual return, minus RF, which is the risk-free rate, and divided by the standard deviation of this thing. So you may be wondering what is the risk-free rate? This is basically the estimated this is basically the rate you would get if you invested in something that is almost like practically risk-free. Usually that's the 3-month US Treasury bill. And the 3-month US Treasury bill is called the risk-free rate because the US Treasury bonds are supposed to be very, very stable. So it's almost as if there's no risk. So what this Sharpe ratio is calculating? It's calculating the like how good a algorithm or portfolio or just like a stock is compared to the risk-free rate. So compared to if you just decided to take no risk and just bought the 3-month treasury bills. Mm, So then it's the return of your portfolio minus the risk-free rate. Why are they dividing it by the standard deviation though? It's because usually like the higher the returns, also the higher the risk. So you want to have like a good um like value for like a good like value for your money. So this is the monthly Sharpe ratio, by the way. RP is the monthly return of the portfolio. RF is the risk-free rate. Mm, and RF is the monthly risk-free rate, by the way. So then you calculate the annualized Sharpe ratio. And this is just the monthly Sharpe ratio times the square root of 12. Okay, does anyone have any questions so far on the Sharpe ratio?
No.
Okay then, cool. So let's just do a calculation example for a summary. So let's assume the risk-free annual return is 4.5%. Can you guys calculate the Hoperation fund Sharpe ratio? Well, actually, you know what, let's just go over this because the calculation process is kind of long and kind of complicated. So the step one is to find the monthly risk-free rate. Given the annual risk-free rate, which is pretty high actually, the monthly risk-free rate is you plug this 4.5% into the formula we talked about before for finding the compound annualized growth rate. So this is just like the compound annualized growth rate formula, except instead of the number of years, you have the number of months in a year. And so you can treat each year in that formula as a month in this period of time. Okay, I think we have a question. So yeah, before we continue with this calculation example, I'll answer it. For the annualized Sharpe ratio, why is the monthly ratio times the root 12 instead of just 12? Yeah, that's a really good question. Yeah, it's a very interesting question. So it's because here, this is the monthly Sharpe ratio, right? This thing is the return, like the top part, then is the return. And this, if you take this monthly return and then you like analyze it, then that's just times 12, right? But standard deviation actually also changes. So standard deviation, I think, increases by the square root of 12. So then if you're trying to analyze this, then you just do the monthly Sharpe ratio times 12 time over the square root of 12. And so that's just like this whole thing times root 12, which is why you multiply it by root 12 instead of like 12 or something. Does that answer your question? Okay, cool. Yeah, I was kind of confused about this too, which is why I searched it up. Um, yeah. So now we have our questions pretty much all answered. We can move on to the calculation example then. So, by the way, if you guys have any other questions, though, don't hesitate to just ask. Like for now, let's continue on to our calculation example. So, plugging in this formula, we know the annual risk-free rate. It's just then calculating the monthly risk-free rate is just 1 plus 0.045 to the power of 1 over 12, the number of months in a year, minus 1, and then get 0.3682%, which is the monthly risk-free rate. Step 2 is to calculate the average monthly return now. So you can sum all of the 22 monthly returns and you get 0.553. So the average monthly return is 0.553 divided by 22, which is around 2.51%. And if anyone is confused, the reason we can just divide by 22, the reason we can just sum all of these and divide by 22 is that we already have the individual returns. But for the monthly risk-free rate, again, you can't just divide by 12 because you have to take into account compounding. Okay, so now we have our monthly risk-free rate and our monthly return. So then we find that monthly excess return is monthly return minus monthly risk-free rate. And so this is equal to around 2.14%. Finally, calculate the standard deviation. The monthly standard deviation using this formula is 4.22%. So then plug everything into the formula. You get the average excess return divided by the standard deviation is equal to 0.0214 divided by 0.0422. This is around 0.507. Analyze it by multiplying by root of 12, and then you get 1.76. So that is the Sharpe ratio for the Hoperation fund, 1.76. The Sharpe ratio of SPY is very close to 1. It's like 1.01. And the higher the Sharpe ratio, the better. So you can see from our example that the Hoperation fund is much better than SPY, according to the Sharpe ratio. So that was a fun example. Now let's move on to classic portfolios. Does anyone have any questions on our calculation example? Cool. So the first classic portfolio we're going to talk about today is the classic 60/40 portfolio. So for the 60/40 portfolio, you invest in 60% stocks and 40% bonds. It's a very simple portfolio, and you rebalance annually. The advantage of the 60/40 portfolio is that it provides mhm, market gains during market rallies and fixed income reliability during economic slowdowns. So you're able to take advantage of both mhm, long-term returns from both the bond and the stock part. So technically, you are supposedly always earning, no matter what. During an expanding economy, the equity or stock part increases in value largely. As the economy goes through cooling periods, the equity part decreases in value, which can be offset with bond performance. Note that this is not always true though, as I talked about last meeting, and as I've talked about many times before, bonds do not always hedge against stocks, um, because when the inflation is really high, then actually bonds will lose, like their prices will lose money too, and then so will your stocks, and then bonds aren't able to hedge against stocks. So you should be careful about that because sometimes, like if the inflation is really high, your 60/40 portfolio may not perform exactly as you thought. Mm, Shrey asked, does sharp mean the peak of a stock? Oh yeah, that's a great answer, Johan. Yeah, you basically just answered it. It's like a reward to risk ratio, yeah. Because if we go back to the Sharpe ratio formula, it's the returns of your algorithm compared to your like no risk divided by the risk or standard deviation. Yeah, great answer, Bihan. Oh, where was I again? Ah, yeah. So that was one attractive feature of the 60/40 portfolio. Another attractive feature is that it can decrease the overall volatility. Since the volatility in the equity part and the bond part tend to offset each other. Even if inflation is high and bonds are not able to hedge against stocks, bonds typically, or at least short-term bonds, typically do have less volatility than stocks, so the overall volatility of your portfolio is still less. So let's look at the historical performance. This is from 1913 to 2013. So admittedly, it is pretty old data. But here you can see the red line is S&P 500, blue line is 60/40 portfolio, and the green line is bonds. The average compound, like the average return each year is for bonds is 1.82%, for stocks 6.6%, and for the 60/40 portfolio 5.1%. The volatility of bonds is 6.68%. I think this means standard deviation, I think. Eight stocks is 18.61%, and the 60/40 portfolio is 11.79%. Note that the Sharpe ratio of the 60/40 portfolio is the highest out of these two. And interestingly, the max drawdown is actually the lowest, like the best. It's negative 52% compared to bonds, which actually has like a bigger max drawdown. Oliver asked, didn't we just calculate the Sharpe ratio of stocks as yeah. Yeah, again, Vihan, good answer. See, I don't even have to answer the question now. Yeah, because it's a different time period, so it's just like before. This is from before 2013. I think nowadays, like the S&P 500 has so many like tech stocks and growth stocks that like I think like the Sharpe ratio is higher now. And also like stocks generally, I think might be better now. I don't know. Although, if you guys are wondering, have I plotted like all of the portfolios against each other with like using this portfolio simulator, and the data goes from 2026. So I'll give you guys a more recent um, in like a more recent graph. This is just from a source, Global Financial Data, which I think has like lower, like not lower, sorry, like older data. Look. The second portfolio we'll talk about today is Ray Dalio's All Seasons portfolio. Oh yeah. All right. So that was the question answered. I think Dr. Zhang just answered Oliver's or said something similar to Oliver's question. Sharp ratio is only meaningful when we compare portfolios in the same period. Yeah. I think a lot of metrics are kind of like that in investing. Like a lot of metrics, like they're only good if you compare it to stocks in the same time period or like stocks in the same industry, same sector, etc. Okay, so next portfolio, Ray Dalio's all seasons portfolio. So this is more complicated than that 60-40 portfolio. Here, it's 30% US stocks, 40% long-term bonds, 15% intermediate-term bonds, 7.5% commodities, and 7.5% gold. Although, like the 60-40 portfolio, you rebalance it annually. And this is a pie chart showing each allocation of like each asset class. In practice, there are many ETFs you can use to build this portfolio. Here I listed it for you guys for your benefit. 30% US for the US stocks, you can do SPY, IVV, VOO, VTI. They're pretty much the same. Long-term bonds, a good ETF is TLT. Intermediate-term bonds, there are many ETFs such as IEF, BND, AGG. Commodities, an ETF, I think I talked about this last time too, is DBC. And for gold, there's a lot of ETFs too, GOD, IAU, OUNC, GFDM, and IAUM. Mm, I feel like I just received a new message. Okay. So this all seasons portfolio is based on Dalio's belief that there are only four factors that move the price of assets. Inflation, which is the increase in prices for goods and services. Deflation, the decrease in prices for goods and services. Rising economic growth and declining economic growth. And there are only according to him, four different economic seasons that will ultimately affect whether asset prices go up and down. And that's the same thing as the four I listed. Growth rising, inflation rising, growth falling, inflation falling. Nobody really knows which economic season will come next. So according to Dalio, you have a 25% probability in any of the four economic seasons. Technically, I do think some economic seasons might be longer than others on average, but it's like you can just estimate to around 25%. So to account for each of these four seasons, Dalio designed his portfolio such that in each of the seasons, there are always some assets with good performance. When the economic growth is rising, then stocks, corporate bonds, and commodities or gold would do well. Stocks will do well pretty obviously because when the economy is doing well and like the economy is growing, the market is doing well, everything is like great, you know. Corporate bonds, because companies do well when economic growth rises, and so therefore they're more likely to pay back their bonds, and their bonds are also like better quality. And commodities or gold, because there's more demand for the commodities or gold in like growing economy. When gold is falling, then treasury bills do well because people want like go for bonds more. They want like a safer option, as well as inflation-linked bonds, also called TIPS or TIPS. When inflation is rising, commodities and gold do well because they aren't very affected by inflation. Sometimes commodities actually have a positive correlation with inflation, and inflation-linked bonds do well. Pretty obviously because their returns like aren't like affected by inflation. Mm. And when inflation is falling, treasury bonds do well, and stocks also tend to do well. Backtesting shows that Ray Dalio's all seasons portfolio outperformed the popular 60/40 portfolio from 1984 through 2013, and it had positive annual returns over 86% of the period. The average annual loss though was just under -2%, which is pretty impressive. When backtested during the Great Depression, the All Seasons portfolio was shown to have lost just -20.55%, while the S&P 500 lost -64%. The -20% is really good for the Great Depression. The average loss from 1928 to 2013 for the S&P 500 was -13.66%, while the all seasons portfolio though was just -3.65%. And even in years when the S&P 500 suffered some of its worst drops sometimes, aka 1973 and 2002, the all seasons portfolio actually made money. And final portfolio for today, the Harry Browne's permanent portfolio. This is a classic all-weather investment strategy, similar to Ray Dalio's All Seasons portfolio too. Again, it's also designed to perform reasonably well across all economic conditions. It's simple, diversified, and low volatility, and it has a one-size-fits-all approach, where you can just set it and you can forget it. This is very suitable for really lazy people or people who might be really busy and know they don't have time to continuously check and update their investment portfolios. This is also pretty good for some retired people too. Actually, all of the portfolios we talked about today, the 60/40, the all seasons, and the permanent portfolio, are all like this. So this portfolio structure also has four asset classes. Oh, actually, no, it doesn't also have four asset classes. It has four asset classes. Each one is evenly divided. Stocks have 25% allocation. Long-term bonds have 25% allocation. Gold 25%, cash 25%. The purpose of stocks is to take advantage of times of prosperity. Long-term bonds can take advantage of times of deflation. Gold can take advantage of times of inflation, and cash can take advantage of times of recession. The design motivation is again that different asset classes will have different returns during different periods. Here, in this period from 1980 to 1999, bonds and stocks both do well. The annualized return of stocks is 17.9 or 18%, while the real return, accounting for inflation, I guess, is 13.3%. The annualized return of bonds is 11%, cash is 7%, and gold is -2%. So gold did not do that well. Then from 2000 to 2009, where bonds beat stocks, stocks did not perform well during this decade. They had an annualized return of -1%, while bonds had an annualized return of 7.7%. Cash, pretty stable at 2.8%, and gold actually had an outstanding performance at 15% annualized return over a decade. Of course, accounting for inflation, the real returns are slightly less. And then in the decade from 1972 to 1979, bonds here are hurt by inflation. So stocks have annualized return of 5.1%, bonds 3.8%, so pretty low, cash 6.5%, and gold, probably because of inflation, had a huge annualized returns, 34% per year on average. So now how would you know which assets perform well under like which economic conditions. So first of all, for the economic condition prosperity, here everything is growing, everybody is happy, stocks have strong gains. Meanwhile, long-term bonds have moderate or stable gains. But like still gains. This is because like the economy is doing well, people like to invest in bonds more. Gold is weak though, because no one really needs to invest in gold, and cash is as always stable. So the return like rank, if we hypothetically ranked each of these assets, would probably be stocks on at the highest, bonds or cash tied, and gold as the lowest returns. In inflation, stocks generally are pretty weak, although some sectors will thrive. Long-term bonds have losses because no one wants to invest in long-term bonds when inflation is high. It's not worth it. Gold has strong gains because gold can hedge against inflation, and cash is stable. So then it would be like gold at the top, cash in the middle, and stocks and bonds not performing well. In the stagflation, which is where there's high inflation and a recession at the same time, stocks are weak, always. Long-term bonds have losses too. Gold has some gains, but not like super high, and cash is stable. So gold and cash would be at the top, and stocks and bonds would be at the bottom. In a deflation, stocks would experience losses. Long-term bonds would experience strong gains. Mm. Oh, by the way, here I said stocks don't do well in deflation. Well, I think previously I put that stocks, some stocks will do well in generally stocks do well when inflation is not very high, but stocks generally don't do very well when inflation is either super high or like super low. Um, and cash is stable. So then it would be like bonds, cash, and stocks and gold at the bottom. And finally, in a recession, stocks will be losing money. Long-term bonds would have strong gains because investors would want to invest in bonds more. I guess gold is weak and cash is stable. So then bonds and cash would be at the top. And here, by the way, cash refers to, it can refer to cash, or also sometimes people will buy like cash equivalents, such as short-term bonds instead. And gold will be in the middle, and stocks will be at the bottom. So here are some historical examples. During the 1970s stagflation, gold surged around 1,500% or 1,500%. That's times 15, countering equity bond declines. Then in 2008 bear market, long-term bonds rose around 30%, offsetting the equity crashes. And here, as you can see, bonds are at the top of our asset rank. And here I plotted the permanent portfolio against stocks, cash, bonds, and gold. And this is from 1971 to 2011. As you can see, the permanent portfolio has higher returns than cash, bonds, and gold, but as you may expect, like lower returns than pure stocks. And so now here's the simulated portfolio growth from 2007 to 2026 June. This is more recently. So here I plotted the 60/40 portfolio, Ray Dalio All Seasons portfolio, permanent portfolio, and S&P 500 index. Green is the S&P 500 index. This is the Vanguard 500 index. Mm, mm, The stock bonds, the 60/40 portfolio is in blue, The Harry Browne permanent portfolio is in yellow, and the Ray Dalio's All Seasons is in red. But honestly, they're pretty similar. Yeah, it's kind of funny the lazy portfolio one. I think it's because it has the. I think these recent few years, like these two-ish decades, stocks have been doing pretty well, while the other asset classes have been doing like just okay. So it has the most percentage of stocks. So I think that's a pretty reasonable explanation why. But yeah, sometimes being lazier helps, I guess. Although all three portfolios are good for lazy people because they don't need really any adjusting. Just like um like just like make sure at the end of the year to like retune your portfolio. So compound annualized growth rate of 60/40 is 8%, all seasons is 6.7%, permanent portfolio 7%, S&P 500 index around 11%. Standard deviation, for the standard deviation actually, the permanent portfolio is has the least standard deviation. The best year is goes to the S&P 500 index, and then worst year max drawdowns. The permanent portfolio actually had a much smaller drawdown than stocks or bonds. And Ray Dalio All Seasons portfolio has pretty low maximum drawdown too. Stocks again have pretty high maximum drawdowns. And then Sharpe ratios, interestingly, even though the stock bonds like 60/40 portfolio had the highest returns out of all three portfolios, the permanent portfolio actually has a higher Sharpe ratio, 0.75, because it has a better return to like risk um, like ratio kind of. Mm. So does anyone have any questions on this? Okay, cool. So I think everyone understood the material today. I hope you guys all learned something, and I hope you guys found these lectures interesting. This will be the last like lecture series. From next meeting, from the beginning of next meeting, we will do a new like type of lectures where the content is more complicated. Mm. So if you if you like think the new lectures might be a little too complicated for you, or maybe like you are kind of you want to like you're slightly struggling to catch up maybe, or like you think you will be, then or you just like want to like really review our old material, then you can always go onto the website and um there will be like here I'll put like the investment lectures. So here are each of the lectures from 2025 to 2026, and then you can go and see each of the summary of the topics and well, these are guest talks, like the summary of the topics and the lecture recordings on YouTube. So yeah, that's it for today.
Olivia, you can also show the investing resources.
Oh yeah, right. So if you guys just want like a quick like recap, and so basically here are some also like some here again are like some of the most um like maybe most like relevant lecture series, and then most of these are also, like these are from the 2024 to 2025 academic year. And here I also put a lot of videos with investing tips too. So if you want to like go beyond our meetings, and here are investing documents, investing tips, mm, and some videos of like interviews of famous investors and just like videos of famous investors talking about investing in finance. So there's a lot of information here. I encourage you guys to more thoroughly explore this website, and yeah, I posted a lot of resources here. There's also member resources, but you need a password for that. Cool. So yeah, that's it for today. Oh, speaking of which, I forgot to show you guys the page for philanthropy, not me. I clicked the wrong thing. The page for the philanthropy committee. So yeah, if you join the philanthropy committee, you'll just like have your profile here. Cool. Mm, yeah, so that's it for today. Thank you guys all for coming. Again, just a recap. From next meeting onwards, we will be starting both the philanthropy committee and our new like series of investment lectures.